Thank you very much, and welcome to the this session. Gentlemen, I hope I'm audible here. I'm Aftab Patel, CEO of Aluminium Financial Services. I have my colleagues with me here, Mr. Brekel Amri, who is the General Manager, Production Services. We have Sami Al-Hasni, who is the Investor Relations Manager as well as HR Manager. And we also have joining by remote Mrs. Lata Ramkrishnan, who is General Manager, Risk Management. Welcome to this session. And we are pleased, first of all, I would like to congratulate and appreciate MSX as well as CMA for providing us this opportunity. I think it's a very great initiative as a new dimension to reporting and transparency as well as communicating with all the stakeholders. And this will go a long way in bringing about more transparency and disseminating written information about the public companies. I think it's a really wonderful initiative. Thank you very much. Now, before we move further, gentlemen, as you're all aware, I would like to give you a brief introduction about Aluminium Financial Services. The company was incorporated in 1997, and this was formed as a public limited company. 60% of the shareholding was then subscribed by the shareholders, privately by the Bank Muscat shareholders, and as required, 40% was offered to public. And you guys would be well aware that this IPO in the year 1997 was oversubscribed by more than 43 times. From then on, it has been a long, exciting, and what you call a very steady journey from where we started to what we achieved. When we started our business by acquiring the auto finance business of Bank Muscat S.A.O.G, which was then valued at about $20 million, and we started with a capital of $3 million. From there to now, to about 200 million reals in assets, almost 65 million plus in net worth, and with the dividend history spanning to about 460% in the span of our company's existence. We are very proud and humbled by our achievement that we have never skipped dividend. We have paid dividend, a cash dividend, every single year of our existence. And this is a proud privilege that I and my colleagues and my board of directors and the shareholders are all very proud of. Now, as you've seen from the slide here, we'd like to present you our board of directors, starting with Sheikh Khalid Al-Wahabi, who's been the chairman of the company, and he's one of the longest serving chairman of the company. And then we have a very eminent board, our vice chairman, Sheikh Khalid Mustail Ahmed Al-Mashni, who also happens to be chairman of Bank Muscat, who has been also in the board of the company for more than 2 decades. We have Mr. Zaki Hassan Nasi, who is the chairman of the audit committee. Then we have Mr. K.K. Abdul Razak, a very illustrious financial professional who has been on board of the company for a considerably long time. We have Mr. Ibrahim Wahabi. We have Sheikh Tariq Salem Mustail Al-Mashni. We have Shikhar Bipin Dharamsi. And we have Mr. Imad Nasir Salmi and Mr. Ketan Denikarwasa, who both work with the Ministry of Defense Pension Fund and with the Civil Services Pension Fund. Ladies and gentlemen, we are very pleased to have this eminent board who have been our source of guidance, inspiration, who oversee the board control functions, as well as the corporate governance function, risk management, and the internal audit directly reports to them, including the CEO. So with this, and we have also a very senior and eminent management team here. This is our, let's go back to our shareholders here first. Our major shareholders are, as you can see, Muscat Overseas, a local multi-services company, 18%. Civil Services Pension Fund 11%, Hina Dharamsi 9.9, Sheikh Salim Mustail Al Mashni 9%, Serene Enterprises 7.437, HSBC MOD Pension Fund 5.4, Hassan Nasir 4.2, Bank Muscat 4%, Parsi 3.3, then another Parsi for social insurance 2.6, other shareholders at 24%. So we have a fairly eminent shareholders, and we are also very fortunate that our shareholders have been almost constant since the inception of the company. All our shareholders have been with us. The next slide, please. We have a very experienced team of senior management with us. I've been fortunate to head this company since the very inception. And I have with me a team who has been with us for more than 20, 25 years. We are very fortunate that nobody has really had a shorter tenure with Aluminium. And we have Mr. who's not present with us now, Mr. Salim Alawadi, who is my colleague and deputy CEO. Then we have here with me Mr. Break Alamri, as we introduced him earlier, very experienced gentleman who's also on the boards and chairman of several public companies. We have Lata Ramakrishnan, who's joined us earlier. And then we have Samia Al-Hasni. And we have a very eminent CFO in Mr. Chandrasekhar. And several other departmental heads and personnel who are very, very dedicated and support you. We see here also our corporate head and retail head, Mr. Varghese and Mr. Ramkumar. We have, this is our management team. Go ahead, next, please. Aluminium has a very wide range of products. We are a boutique finance company. On the corporate side, we almost do everything. As you can see, we do working capital loans. We also do asset loans for plant, machinery, transport equipment, commercial vehicles. We do a bill discounting, project financing. Go back to the previous one. Yeah. Project finance, bridge loans, construction loans to warehouses and factories. We also accept fixed deposits. And on the retail side, we do all kinds of equipment, including cars, commercial passengers, etc. And the retail side is basically targeted towards salaried individuals, self-employed individuals, and small and medium enterprises. We have a micro loan product called Lifestyle, which is basically a consumer loan product, which is for both self-employed individuals as well as for the salaried individuals. Next. Now, what is the unique selling proposition of Aluminium? We are a company more than 25 years old. We have a tremendous dividend track record. We are a company that has one of the cleanest books, right? We are bluest. We believe that we have a lot of blue chip clients. We generally cater to the what you call as the non-subprime. We don't cater to the subprime segment. No, we cater to the strong SME segment. We cater to the individuals, large corporates, etc. And we are a market leader in the large corporate segment, I think, because of our high net worth and the business that we have built over a period of time. We are very happy that we deal with most of the large listed companies, large family businesses, and large, SMEs, etc. As you can see from here, I have already talked about the dividend payment. We also have one of the highest NPA coverage in the industry, and we have the lowest NPLs. Our asset quality is good. Our net worth is about 67 million, which is very, very robust, and our capital adequacy is extremely high. We have a very visionary board, and I have a very competent management team. We have been rated very high, and we are in a position We have the ability, we have the competence, and we have the resources to move forward and grow as soon as we see the economy growing and the offtake of product improves. Gentlemen, this is our dividend history. You can see from the year 1997-98 was our first year of operations. And from then onwards, we have consistently paid dividend every single year of our existence, right? Yes, even in the bad pandemic year, I mean, where we were generally, I think, across the board, every industry suffered, we still managed to make a profit and pay cash dividend. Last year, our dividend was 12%, and it is our endeavor to maintain a sustainable, robust, and a consistent dividend, keeping in mind the needs for the growth and the capital expansion, etc. Now, if you look at a closer look at the Oman's economy, we all would agree that we went through a bit difficult phase, right, right from 2016 onwards, when we started seeing a fall in the oil prices. We were running a budget deficit almost at the rate of about 20 to 25%. Our sovereign borrowing shot up to almost 80% of our GDP. Cost of borrowing was consistently increasing. Oil prices were falling. And as a consequence, we also saw a diminished expenditure on the infrastructure and other development expenditures. Now, in that difficult period, we also experienced 2 difficult years of COVID. I think I would like to really appreciate and commend the efforts made by the government of Oman, the Majesty Sultan, for managing the COVID in a most efficient and in a very, very good manner by making sure that by appointing of the High Committee, who I think, along with the Ministry of Health, the hospitals, I think did a tremendous job, availability of vaccines, etc. So I think all in all, we managed to get out of the COVID without too much damage as compared to the other economies and other governments. And during this period, I think the Central Bank of Oman, in line with the vision expressed by the government of Oman, came up with several policies to benefit both the corporate, the SMEs, as well as the individual, those who had suffered from the COVID. We saw moratorium being given for almost 2.5 years. We saw some legislation being, being sort of tweaked to make sure that the economy does not get, unnecessarily burdened by the COVID. And I think thanks to these policies, we are emerging as a much stronger economy. We are emerging as a stronger nation. And also, we have seen now that due to the increase in the oil prices, that our fiscal position has improved considerably. We are expecting a surplus of about 5.7% and a GDP growth of about 4.5%, which is quite remarkable considering what we experienced in the last 2 years. We're also fortunate that our ratings have improved. We've seen the oil revenues going up, the surplus is going up instead of a budget deficit, which we had for the last 5 years. 2022 saw for the first time a surplus budget. We are back to being surplus. And under the wise policies of His Majesty, I think the government made a very wise decision in repaying some of the debt and improving our fiscal position. Our fiscal position and parameters have improved in all aspects, and that is quite visible in most of the rating agencies who have upgraded Oman outlook to stable from negative, and also from BB minus to BB is a significant improvement. We also seen that our cost of borrowing internationally coming down, and there's a lot more appetite for the Omani paper in the international market as compared to what we are seeing in the year 2020 and the early part of 2021. Here is a look at what's been happening on our budget, on the Oman's oil revenues, which are major source. We can see here that there has been the average production has gone up substantially. And more than that, our average oil price revelation in the first 6 months has been almost 40% higher than what we saw in H121, from $53 to $87. And so consequently, our revenues moved up from 2.2 billion to 3.1 billion in real money. I think that's a very, very considerable improvement. And you also see here what are our numbers in 2021 and in 2022, right? In H1, we have seen our revenue growth, and we have seen a surplus of 784 million in the first 6 months, as compared to a deficit of 1.2 billion Omani riyals. I think that's a very, very significant thing that has happened, and as a result of which we have seen improvement both in our fiscal parameters as well as in our capital expenditure spending. Here is another representation of the same. You can see here both the figures for 2021 and 2022, and we are back being in the green. Now, the important item, gentlemen, I would like to present to you here is our development expenditure, just about 299 million in 2021. In the first 6 months has already moved up to 413 million, which is an improvement of 38%. Going forward, I think with what we have seen, the announcements that are being made and the tenders that have been awarded, we hope to see a much greater improvement and increase in the development expenditure, which will then have an all-round impact on the economy. We will see the trickle-down effect coming in soon. We're also beginning to see increase in the offtake of credit. And the last report you see, overall credit has grown both to the corporate and to the retail sector. Next slide. How did the government benefit from the additional revenue? It's very clear here. Expenditure compared to 2,299 million that we have already commented upon, the development expenditure, and another 650 million has been allocated to the list of projects for the 10th five-year plan. Such projects are implemented across various sectors such as health, education, housing, transport, tourism, and municipal services. I think this would be a tremendous boost, especially in what we saw in the last couple of years. And coming out of that, this will have a tremendous impact on both the employment, offtake of credit, and we'll see also the trickle-down effect impacting various other sectors. We've already seen that the post-COVID scenario, the civil aviation sector has improved by leaps and bounds. We have seen the number of flights coming in and taking off, going up by about more than 300%. The hotel occupancies have gone up by more than 200%. The revenues have more than doubled. We are seeing a lot of incoming tourists coming in. So all in all, I think we feel that both 2022 and going forward, barring unforeseen circumstances, we also see that uptake taking effect in the year 2023. Next slide. Yeah, we also know that the war in Ukraine has impacted all of us. One thing is the international increase in the oil prices, and also a lot of increase in the consumer-related input, and especially the food prices. We've seen prices of corn and basic food all going up, and in response to that, you can see here the government of Oman has been very responsive. They have increased the subsidy going forward, and I think this will mitigate the impact on the people who are going to be sort of impacted severely by this. By the end of 2022, our debt amounted to 18.6 billion, which was down by 2.2 billion as compared to 2021. But this is one of the most welcome signs. What the government has really done is they bought back some of the sovereign bonds at below its nominal value, so that's been a saving. We also prepaid some of the high-cost loans and some of the sukuk and bonds have been issued at a very preferential rate. So all in all, we have seen the fiscal parameters of the improving, and as a result, we also seen the rating agencies improve our ratings, and that's a welcome sign. And we're also able to raise money at quite a competitive cost. Yeah. So I think we are on a declining trend of our public debt from almost 20 billion to 18.6 billion. Hopefully, by end of this year, we might see a further decline, and that augurs really well for the economy as a whole. Gentlemen, I want you to briefly take you through the performances, just the bird's eye view of the performances in 2018, 19, and 20 and 21. As you see, I think with the declining oil prices that we saw, we did have what you call, offtake of credit was beginning to come down a bit, and of course with the COVID years, we saw a dramatic fall. We saw a lot of what you call disruption in the businesses, the aviation sector being closed, lockdowns, and I think all in all, we have managed the COVID, with the help of the government of Oman and the Central Bank of Oman. We have minimized the impact. We also had a very benevolent policy within the company on the COVID, like making provision for the vaccines and the medical treatment, etc., for all our employees. As a result of which, I think we are very quite happy the way we managed and we came out. Even in the COVID year, we paid a dividend of 4% cash. And whereas, you would have seen that most of the companies not only skipped dividend, but also had other issues. 2021 has been a dramatic improvement for the company. Our profit jumped by more than about close to 100%, and pre-tax profit was more than 100%. Whereas our market cap grew from about 60 paisa a share, 70 paisa a share to about 170 paisa. So that was almost a growth of about 200, 250%. I think our dividend also grew by 300%, from 4% to 12%. We managed to retain our important client base. We managed to improve all our parameters and maintain them. Our provision covers was maintained. Our quality of book was maintained. So that was one of the objectives that we worked on, right? And you would have also seen the kind of liquidity that the company maintains here. It's very clear that we maintain a significant liquidity, and that liquidity is being maintained that as soon as we see the improvement and offtake of credit improving, we will have a very quick and immediate ability to get into the market and increase our lending portfolio. That's the philosophy that we operate on. This is our income statement, what we reported, and I believe that all of you must have read this through. This is for the June ending 30th June 2022, the first half. We have seen our revenue, net revenue was 7 million against 7.4. Interest expense have been marginally down. Our operational costs were slightly higher. Provision for credit losses is substantially down because we have substantially provided in the previously. As a result of which, we have seen a growth in our profit before tax as well as a growth in our after tax. This gives us EPS of about next slide. Yes. So from here you can see that by and large our assets have remained constant from 110 to about 108 million. Because our provisions have marginally gone up. Our deposits have remained constant at around 84 million. And also during the year, we converted one of our dividend convertible bonds into shares, as a result of which our paid up capital went up marginally, increasing the what do you call as our the equity capital of the company, and all of the parameters, gentlemen, have been very much under control. Next slide. Yes, this is a very simple what is there in our published balance sheet. You can see the reduction in the unsecured compulsorily convertible bonds from 5 million to 3.4. So 1.6 million was converted into equity as per the terms and conditions already approved. Now, another unique development that I would like to bring it to your attention, gentlemen, is that for the last year, we issued unsecured, non-convertible, redeemable bonus bonds. Now, these bonds have been issued by Aluminium with the approval of the central bank and the CMA. But what is important about is this is first time in the history of Oman, in the company's history in Oman, that any company has issued a redeemable bonus bond. So this is augurs well for the different types of instruments that can be brought about to manage your capital structure, as well as the instrument required to manage your liquidity and to address the mismatches in the borrowing. So I think that's a very important dimension that we have added here, and we're happy about it. We'd like to thank the central bank and the CMA for it. You can see here, as I mentioned earlier, there has been a growth in our capital with the conversion from 29.1 million to 30 million. Almost 1.1 million shares have been added. A legal reserve has marginally gone up. As a result of the conversion, we also have added something to our share premium account. Exchange reserves required to be created as per the accounting standards. And we also have a special provision for non-performing assets, our retained earnings, and therefore the total equity is 65 million, which is probably one of the highest shares. This is how our stands. Our EPS is 4.4 for the first 6 months. So we expect, hopefully, to continue to maintain the same level of growth and maintain the EPS at what we have achieved so far. Our interest margins are probably, our interest cost is one of the lowest in the industry, as is visible from here. Our yields are 9.7, and what I would like here to point out to you is that our NPLs is 4.18%, which is lowest in both the non-banking finance industry and the lowest NPLs that we carry, just 4.55 million. Next. Here, this is from the published figures of all the finance companies. These figures are from the published results, and we would like to just bring to your attention here that our NPLs are 4.18%, and as compared to probably the industry average of about 20%. So that's we are, how clean we maintain our books, and we also have a philosophy of robust write-off so that we are able to, maintain and only create an upside to our balance sheet. I have briefly touched upon these subjects. We have substantial capital and liquidity buffers. The central bank has been strengthening and the regulatory and supervisory frameworks. So we have a very high net worth, a loan book, lowest NPLs, and we have tremendous liquidity to benefit from opportunities that we see the green shoots already appearing. Okay, gentlemen, we now open the session for questions and answers. And we would request you to introduce yourself and state the question.
Afternoon, sir. This is Abbas Muslimi from Vision Asset Management.
Yes, Abbas, go ahead.
Thank you very much for the presentation, and thank you to you and the entire team and the board for being such great custodians of shareholders' wealth over the last many years. I mean, your point about being consistent dividend payers and having one of the strongest sort of balance sheets in the industry is well noted. But as always, as investors, you're obviously looking forward, and you're trying to uh, create as much value from your holdings as you can. So in that sort of context, when you look forward to the market, and you've touched upon a lot of things in what's happening in the industry, how you guys were being careful when Oman was going through a bit of a challenging situation. But now that you move forward, and how do you see your loan growth evolve? Because your metrics are in place, your asset yields, your spreads, your credit quality is obviously leading the sector. But when you move forward, what's your prognosis of growth coming in? And do you have like a sort of target loan growth in the current scenario for the next couple of years, or do you look at business in a different manner?
Okay, thank you, Abbas. What I would say is, that first of all, being conservative just for the sake of conservative is not our philosophy. What we would like you to point out here is that, in spite of being conservative, we have really paid one of the highest dividends. So, if you compare us to our peers, I don't like to be compare myself to say I'm good, bad, or ugly. It's your call. So what I'm saying is that if you compare and if you say we are conservative, then it is good to be conservative because with conservative you're paying the highest dividend, right? Our market cap is growing, then our liquidity is very high, our interest cost is one of the lowest. So I would request, I think this is the way to go forward. Now, if I had, say, skipped the dividend or I was paying a lesser dividend than somebody else, then there to be some question mark on being conservative. So we are not really conservative. We are appropriate. We respond to the market dynamics. We respond to what's happening in the broader economy. For example, I'm sure you're aware that the economy itself went through a difficult time, and then it was a double whammy that we are hit by the COVID. Now, coming back to the future, what we have is that we really say that we are sitting on tremendous liquidity, right? We have defined what our credit parameters should be, and we'll write as much business that is available. We're not going to be governed by a target, by a budget or something. We don't say, oh, I finished my target this month or this year. No, there is no such philosophy in Aluminium. We are focusing on the right segments in our opinion. We believe that our focus has been on now on the oil, on the gas, on the hospitality with the new COVID going away, right? We are on the high-end oil and gas SMEs also. We are into family businesses. We are also into what you call syndication with the banks. So we are a boutique finance company, and we would like to grow, but not at the cost of the shareholders, not at the cost of writing, which we believe is a subprime business. Because see, subprime business has a huge cost, right? And we've seen the kind of grief that you can come into if, unfortunately, you end up having such. So, answering your question, we are seeing some offtake of credit improving. But at the same time, we also seen that inflation has been substantial now. We've also seen shortage of capital goods here because there have been supply chain bottlenecks around the world. For some of the vehicles now, the waiting period is as high as 12 months, right? So, all in all, I think we hope to improve on our performance. We hope to reward the shareholders and have a very balanced growth in place. I hope that answers
Okay.
your question.
Sure, of course. Yes, thank you for that. And my other question was that you managed to shrink your loan book when things were challenging, and I think that was, in hindsight, and I'm sure in your case, you did it very consciously. A fantastic decision to sort of retain shareholder wealth. And but one thing which stands out is, of course, you said you didn't like to be compared, but when we look at cost of risk, and this is after cutting your loan book from 200 million or 200 million. But if I look at the net provisions that the company, declares on an annual basis, it still seems on the higher side. Like we're looking at 3% cost of risk for last year, when your peers who have worse metrics than you, their cost of risk is actually lower than yours. So the way we calculate cost of risk is net provisions upon net loans. It seems Alumania, whatever, I mean, I'll tell you. So basically, what I can't appreciate is for a company who's prudently cut its loan book, its cost of risk is still much higher than the rest of the sector. And could you comment on that, sir, please?
Actually, you see, everybody has a policy in place, right? Everybody, for example, what is the best parameter to look at your loan book is, say, what is the percentage of your non-performing loans to your total loan book, right? So
Sure.
if you have a book, if you do X amount of loan and you say X percentage is bad and the rest is good, that means by default, the lower your percentage, the better book you have. Correct? Now I showed you one
Yes.
chart. I showed you one chart where our non-performing loans, right, are 4%, let's say, as compared to some of the other players of 25, 26%, right? Now, we in Alumania, the way we are, our policies are there, the kind of book that we would like to have. We don't feel comfortable with having very high levels of NPLs. Therefore, the COVID year, you know what? It is like this: whether you recognize your uh, cost now or in future is a judgment, right? Our view is that if we see some cost which is likely to arise, we recognize early so that there is a consistency in our earnings. Now, it's not fair to compare it, but what I'm telling you is that, you see, among the industry, I think we're probably the only company who has paid dividend every single year. We never skipped dividends, right? We never had liquidity issues, and so on and so forth. So if you want to maintain that, you got to recognize your costs as soon as they arise, not when you are going to be actually hit by them. If you recognize when you are hit by them, in those years, you are struck with saying that either declaring a very low profit or skipping the dividends. We don't have such a situation. Therefore,
Yes.
like you see
Okay.
now, one more thing, if you see the year 2022, our provisioning level has been lower. I think we have probably provided almost 25 to 30% lower than what we did last year, right? And
Yeah,
I
I'm
believe,
actually just
I
scaling it to
believe
your
that
competitors
going
when it comes to a
forward,
percentage of loan books, sir. I'm not looking at absolute numbers. I'm kind of comparing it to your loan book and looking at you versus peers. And that's where Alumania still seems to be on the higher side, which is a surprise to me, I'll be honest with you.
okay, you know what? Like I said to you, we recognize costs, what we believe we foresee, right?
Right.
So there is what we do really do is a sort of, in a worst case scenario, there will always be an upside to our balance sheet than a downside.
Yeah. Okay.
All right.
Uh, I had another question regarding your, the slide that you spoke about your sort of NPL ratios against your peers, and clearly your provisioning coverage ratio stands out. I mean, that's one of the reasons why your dividends have never been rejected by the CBO. They've never come back and asked you to revise it downwards. In fact, they've allowed you to issue these earlier convertible bonds and now redeemable bonds. But at what point you as a CEO or the board feel like you're over provided and maybe there should be a provisioning release into retain earnings, which could then be distributed to shareholders? Because the objective of every company would be shareholder value maximization, right? So while it's very, very well appreciated the kind of value protection that you've done on behalf of shareholders in these very, very challenging years, at what point do you take a view that maybe the company is overprovided and maybe, like you said, you're not conservative for the sake of being conservative, you're pragmatic, you're opportunist. So when do you feel that the company is sitting on probably a little bit more than you should be sitting on from a prudent point of view?
You see, what we believe is that we have an appropriate level of provisioning, right? And I don't think we really have any excess provision given a particular year if you look at it, because it is a risk perception that we provide for. If the risk doesn't materialize, in the following year the provision will fall. So, but there is nothing like really over provision. There is appropriate provision and there is a less provision. For example, I'll tell you just to give you an example. Now, when you write an examination, right? Let's say you pass at 40. If you get a 40 marks, you pass. So the person who gets 40 marks is also a pass. He qualifies for that degree. And the person who gets 90 also qualifies for the degree. Both get the same degree, right? So it doesn't mean that they don't have the degrees. Both are passed. So it really depends upon whether you want a distinction or you want lesser than a distinction.
Okay, fair. I take that analogy. Thank you for that. The other question I had is you were seeing consolidation happening in other financial sort of sectors. You're seeing banking sector going through a couple of consolidation. One has already happened. There's another one on the way. You're seeing that with the insurance side. A couple of people are talking about mergers. There's one acquisition that's already happened. How do you see consolidation in the leasing side? Given and especially in the scenario that the sector is coming off a very challenging few years. I mean, the challenge started pre-COVID. How do you see
Yeah.
consolidation and what role will Aluminium play in this consolidation opportunity?
Now, if you see, I think there is a tremendous rationale for consolidation. There's no doubt about it. I believe that we need the size, right? And the benefits of size are there, right? And that is the way going forward is the consolidation, mergers, and things like that, right? Having said that, I also think that if you look at the current leverages for most of the financial institutions, are extremely low, which means that we are all sitting on a huge potential. For example, the balance sheet capacity to lend is multiplied by 6 times your what do you call your net worth. And today, none of us are leveraged to 5 or 6. We're probably even leveraged lower than a manufacturing company, which means that each company by itself has a tremendous potential to grow on its own, even without having to merge. Right? Now, for example, if we, in the next couple of years, could easily grow, but there is a rationale, but there has to be meeting of minds. It's not just mixing of the businesses; it's also the merger of the culture, the people. So the people to people coming together and creating a one new entity with the shared values and with the shared work ethic is the most important. A lot of mergers fail simply because there is no meeting of minds. And we are always open. I mean, we would love to look at if there's anything in the web, we would love to look at. Alumania has the capacity to do it. We really don't need to go back to the shareholders to raise any further new capital, etc. So I'm there. I agree with your analogy that yes, that is the way forward.
Okay, thank you for that. And my last question is, you like you rightly said that this redeemable bonus shares coming in from the retained earnings is something that you guys actually did last year. You all initiated that, and now recently, I don't know if you've been following the market news, but Bank Muscat did a capital optimization plan where they issued a similar sort of redeemable perpetual sort of product, in the sense that they capitalize retained earnings, and this is their way of rewarding shareholders with a one-time dividend, because CBO policies did not allow them to issue special dividends or higher dividends from their annual earnings. Is that something that you will be open to the idea of actually maybe looking at a capital optimization and then sort of giving out I mean, I know you've been a consistent dividend payer, but is there an opportunity when you look at the strength of your balance sheet of a one-time dividends?
I think Abbas, if you look at what we have done, I think we kind almost pioneered the convertible bonds as stock dividends, right? And almost every alternate year we have been issuing convertible stock dividend as bonds, right? Now, there's a little difference between the convertible and perpetual, right? And perpetual can be redeemed anytime anyway. Correct. So I think we don't want to look at it as a one time, but we'd rather look at as optimizing our dividend by using the cash dividend along with both convertible as well as redeemable bonds as our dividend paying strategy.
Okay, I think I got my answer. Thank you very much for very patiently answering all my queries, and all the very best to you. I'll take my if I have any question, I'll come back. I'm sure my colleagues have some questions for you, sir.
Sure, sure.
Hello.
Yes, please go ahead.
Good afternoon, sir and team. Thank you so much for the presentation and answering the questions. I just had a comment, or rather, a question on the ROE generated by the firm. You rightly mentioned the company has been excellent when it comes to dividend payment across metrics such as low cost of funding, high yields, spreads, NIMs, everything. The company is probably the market leader without a doubt. When it comes to ROE, and again, it might just be a financial metric, but that's something, as an analyst, it's one of the things that at least we are bound to sort of look into more closely. If you could just comment on that, because on that metric, I mean, I'm not comparing you to the sector, but I'm sure you as shareholder, as management, and as sort of reporting to shareholders, they must be having some aspiration with regards to what a sustainable level of ROE would be. And over the last few years, we found that on the lower side. If you could just comment on that, sir.
Mr. Balla, can you introduce yourself?
Yes, sir. My name is Bishan Bhalla. I represent Vision Asset Management.
All right, Mr. Balla, you know that obviously, the challenges that we all went through, 2.5 years of COVID, right? And even prior to the COVID, as you were, we saw in 2015 onwards a gradual and a sharp decline in the oil prices. We started facing a budget deficit since then. Prior to that, we always had a surplus. Our per capita borrowing went up. There was a reduction in the development expenditure, and so on and so forth. I think the economy was also beginning to feel the pain of all that, and then we were hit by the COVID. So what really has happened? You see, if you look at our capital structure, a lot of that capital that you see there has been built up through what you call as stock dividend and stock convertible bonds and so on and so forth, right? We don't have this slide now, but in terms of value creation, in the 70, 65 million or 70 million net worth that we have, I think not more than 25% must have come as cash from the shareholders, right? So a lot of shareholders, unfortunately, our shareholders have been with us since inception. So they are able to take a much holistic view of how their investment in Alumania has performed, right? So from that point of view, we look at, like, and say, ultimately ROI is important, but what is also important is your dividend. For example, there might be a company, I don't want to take any names, it's not fair, but there might be, say, a manufacturing company or any other company who has a high ROI but doesn't have enough cash to pay or is not adequately provided, so the dividends are not approved. So what sense does that makes? So you have to have an appropriate strategy depending upon what your regulation under which you're operating and what the market and economic dynamics are. So
Okay.
I hope
Uh,
that answers your question.
it does answer my question partly, sir, because like you rightly said, where it's like studying for an exam and getting 40 or getting 60, and in both cases you pass. And from that point of view, I take your point that on a report card basis, probably Alumania is the class or the university topper, which is fantastic. But as an incoming investor today for the next 3 to 5 years, if I were to bet on Alomania, and why should I not? I mean, given the metrics that you have, they're all excellent, and I completely appreciate that on a past basis you have done exceedingly well for all shareholders and for investors. But looking forward is all. That's my only sort of challenge, or the question that I'm trying to put across, that
Mr. Balla,
going
if you
forward from
see,
today for the next 3 to 5 years on an ROE basis. Again, I get it. I'm fairly confident that dividends will come through. That's all I wanted to just follow up on, sir.
yeah, but if you also go back and look at that, what do you call slide that we presented on the dividend, and if you look at our dividend from 2002 to 2017, we paid between 20 and 25% dividend. and most of it was cash. So the company is not averse to paying a very aggressive dividend, but we don't want to pay at the cost of the provisioning, at the cost of the shareholders, long-term, what do you call, wealth creation. Now, what really happens is you can benefit from low provisions in one particular year. A lot of you have to realize that today you see in one of my slides that I showed to you that my average cost of borrowing is probably half, right? It's just 3 and 3.9% across all segments put together. So what happens if I was paying 6? If I am not as efficient in terms of what the books that I present and the liquidity that I present to my lender, I would be paying 5 to 6%. That completely wipes out your profit. So the beauty, the secret of all this business is really it is your lenders who ultimately will pay for your provision. And that's the book that we need to present to them all the time, the quality and the liquidity.
Noted, sir. Thank you so much. I'll come back if there are any further questions. Wish you all the best, and thank you so much for patiently explaining my queries. Thank you, sir.
Very waiting one, right?
So, if gentlemen, if there are no more questions, Patel would like to thank you all for attending. Unless there are any further questions, we still have about 5 minutes slot before we have to close this session.
Fine, then. If there's no further questions, gentlemen, we'll close this session if there are no further questions. Yeah, but you're most welcome to write to us and email us if you have anything. We'll be very glad to clarify whatever you can. Thank you very much.